Welcome back to another episode of Investing Explained. Here's today's question.
Cool question. And Thailand is a beautiful country. I've been there one time and it was really neat. So I just wanted to throw that out there. But I like this question. I think it's an important discussion to talk about what happens during a large credit contracting event first. And then maybe we can talk about some of the hypotheticals of what could happen with Bitcoin. So when we talk about a credit event, what's happening is all the credit in the system is drying up and then it's contracting down to its monetary baseline. And so let me explain this for anyone who doesn't understand what I mean by that. You first have to understand how a fiat currency works. So a fiat currency has what's considered a monetary baseline component, and then it has a credit component. The credit is made up of the fractional reserve banking that happens. And if you don't understand what fractional reserve banking is, I'd tell you to Google that, learn a little bit about that, how when a central bank puts more monetary baseline into the system, how the banks can then expand that and basically create credit around that. Once that credit expansion reaches a limitation and it starts to basically get super saturated, is the way I like to call that, it starts to contract and it has a tendency to accelerate as that contraction occurs. And what it's doing is it's accelerating back down to its monetary baseline. So just for simplicity, let's say that $20 is the monetary baseline, and then another $80 is credit, making up a total for the entire economy of $100. Once that gets to the $100 limit and it gets super saturated at 100, then it starts to contract back down. It goes to 80, it goes to 60, but that $20 component of the monetary baseline does not dry up. Only the credit part of that dries up. So when you think through this example, if you're valuing everything, commodities, you're valuing stocks, you're valuing bonds with this money that's in the system, the $100, as that contracts, the value of everything else is going to go down right with it. So the price of gold, if you go back and you look at gold during the credit contraction of 2008, and this is really from kind of like the summer period up until maybe Christmas of 2008, you actually saw the price of gold go down, I want to say by 20 or 30% during that period of time. And the reason you saw the value of gold go down is because all that credit, all that fiat credit was drying up. And so since gold is somewhat fixed in the amount and the quantity that exists in the world, if you're using these dollars to value that and those dollars are contracting and disappearing, you're going to see the value of gold go down right with it. So with all of that said, and let me just add to that, as soon as that credit event contracts, okay, and we saw this go full contraction back in the last credit cycle, I would say, what would you say, Stig? February to March, somewhere in there of 2009 is when you probably saw credit. I think that's about when the timing was. Is that right?
Yeah, it sounds about the bottom. And I think gold even like from the year end was like 24%. It just shut up.
Yeah. And so you saw gold even front run that a little bit. Gold hit its complete contraction, I want to say around Christmas of 2008, and then it started going up. But in general, you'll see everything contract, even commodities that have like a fixed supply of those commodities. They'll contract up until that point where the central banks then do their expansion again, and they start, in the last cycle, it was all this quantitative easing. They started pumping more dollars into the system. They started buying bonds off the market at any price, and they started fueling the system with more fiat into it, which expanded the monetary baseline. And then the credit came after that. And I fully expect to see something like that play out again whenever the next credit event happens. I don't necessarily expect a credit event happening here at Christmas time of 2017, but you never know whenever these things could hit and what might trigger it. I mean, you could have some type of global event, call it a war, something that could maybe cause a credit event to start trickling down and kind of compounding on itself. You don't know when that's going to happen. So when all that happens and you look at Bitcoin specifically, which is I know where your question was at, Bitcoin, in my personal opinion, will be treated as a fixed supply just like gold. That's my opinion. Other people might have an argument against that, but my opinion is that it'll be just like gold. And so my expectation for that first part of that credit event or that credit contraction, whenever it happens, is that the value of Bitcoin will go down just like any other stock or bond or anything. Now, once that kind of bottoms out and in the past, the bottoming has happened pretty quickly because central banks had interest rates to play with. They dropped interest rates. They were able to expand the credit supply very quickly, like within 6 months to 9 months. And then you saw a very abrupt rebound in things like gold and commodities that had, a fixed supply or a fixed supply to demand ratio there. And so I would expect to see the kind of a similar thing play out in Bitcoin this time around. Where that might be different is if somehow maybe Bitcoin is part of the reason for the meltdown, which, I think that might be a way far off reason. But I mean, it's definitely in the realm of possible. That could maybe make my whole underlying assumption of all this stuff false. So at the end of the day, I have no idea, but I hope some of those ideas and kind of that thought process of how credit events kind of work help you think through what solution you think might occur. So I'm curious to hear what Stig thinks on all this.
So what we know, at least based on history, is that if a crash should occur, you will have the contraction that Preston talked about before, and then you're just going to see the Fed start pumping out a bunch of liquidity. One thing that you'll see is likely that they will lower the federal funds rate, which is basically a rate that's maintained by the Federal Reserve, and that is the cash that flows in and out. You can look at it in terms of deposits between the banks, and if that rate is high, they will have more incentive to hold on to that cash. But if it's low, they will have more incentive to push it out into the market to get the production going. So I'm pretty sure you will see something like that. The Fed has also recently hiked rates, probably because they would like to have some ammunition if we see a crash. The other thing, at least what we saw last time, was they started with quantitative easing. They started up almost right out of the gates, buying up $600 billion in mortgage-backed securities and agency debt. So who knows if you might see something similar to that. But when it comes to Bitcoin, I think this is very exciting because I just talked about how you will put out more liquidity. Preston talked about a fixed monetary baseline. I'm not sure that is what investors will think if this should occur. I think that investors would say, I find gold to be safe. I'm not sure they will make the analysis because it has a fixed monetary baseline. That's usually not how people talk to each other. Probably not. But it would seem like, so if the state is pumping out of funds one way or the other and gold cannot, like how would that go to inflation? I think it's all about safety at that point in time more than anything else. So the question is really, will people perceive Bitcoin to be safe whenever that happens? And I think that is really going to be the big question mark because we've never seen anything like that for Bitcoin. If you think about it, came out in 2008, I think. So, and it was very, very small. You couldn't really use that for anything. I think that the potential upside is huge. But again, the downside, we don't know about that.
One other thing that I want to piggyback on what you were saying there is we have seen it in Cyprus and we have seen it in a couple other locations where they have had basically a meltdown in the fiat of the domestic currency, and Bitcoin has done extraordinarily well in those locations for obvious reasons. But I'm not necessarily saying that's what's happening in the next credit event. I think it could, but I think it's something that people need to be aware of. And Stig lightly hit on this as well. Is like, what does the Fed do if they don't have much interest rate to play with and the market starts to contract in a major way? Well, I'm of the opinion they're going to definitely go to quantitative easing, and they're going to go to it in a massive way. And that's going to be interesting to see how that all plays out and whether that's going to be enough to stimulate the economy as fast as it did during the last credit event. But, they've replaced a lot of credit with dollars, and I think they're going to do that again. So we'll see what happens. But those are some of our thoughts. We definitely do not know what the heck's going to happen. As far as I'm concerned, it's 50-50 as far as it going up or going down. I have no idea. But I think those are some of the important things to consider when you're thinking through what might happen.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.